Not only in the creative agency industry, but in small businesses in general, once you grow past the solopreneur stage and you now have a team, you now have overhead, payroll to maintain, the conversation stops being just about tax compliance, okay? It also becomes about margins, about running a better business. How can you run a better business? But if you're running an agency and you're clearing half a million, 1 million, $3 million or more in revenue per year, and you don't actually know what healthy margins should look like for you, hey, it's very difficult to know whether you're doing very well, you're doing okay, or whether something in the business needs to change entirely. So in this video, we're gonna walk through what margins creative agencies should be looking out for and what healthy agencies tend to look like from my financial perspective. I'm Jose Cardenas, CPA and enrolled agent at Westfront Tax and Accounting. We provide bookkeeping, business accounting, and tax services to service businesses with a specialization in creative agencies. As an agency owner, knowing your margins is extremely important because it lets you compare how well you're running your agency in comparison to your competitors, to those other agencies also targeting your niche industry, regardless of your size and regardless of their size. You sell scale. And when you have a team on payroll, you're able to offer that scale how? Via labor. This, in essence, is what makes labor in your agency the largest and most valuable resource. This is why questions such as when you should hire, what kind of role can you afford, or how many more retainers or projects you need to be able to add that one person, that extra person to your team is so important because they have a direct impact on how well you make money. The problem is that most profit and loss statements, also known as income statements, they're just top line revenue minus expenses. And in those expenses, you have both operational and direct cost of production all mixed together in one bucket. Because of that, I have noticed that most agency owners only look at their financials maybe once, maybe twice a year at their QuickBooks report. And it gets better because that number that you get after subtracting those expenses from your top line revenue is still missing taxes. So we first need to have the right structure in place on your profit and loss statement, which is divided into 3 sections, okay? You first have your gross profit, then your operating profit, and then your profit margin. The first section gives you your gross profit. Very simple, yet very important. This is your top line revenue minus direct cost of production. This number tells you whether the time your team spends producing the work, working for you, is actually translating into profitable revenue for you, or it's just keeping everybody busy. This is why it is a ratio percentage that is often taken into consideration when we talk about team capacity, hiring, and client profitability. I personally like this metric because it is very easy to see if your team is doing better or doing worse. And it really is a sobering pill for most agency owners once they finally get to see how sensitive the inverse relationship between your revenue and your gross profit really is. So for example, if your top line revenue went up by 10% and your gross profit went down by the same 10%, that tells me that you're either at capacity or somewhere along the workflow, your workflow, something is taking longer than what you think. And typically, your gross profit percentages, and by that I mean as a percentage of your top line revenue, of course, it should be very high, especially when you have a small team of say 3 to 4 people. But as you grow into a larger team structure, you should ideally aim for your gross profit to never, ever be less than 50%. So it should be higher than that all the time. The second section is your gross profit minus your operational expenses to give you what we call your operating profit margin. Comparing your gross profit versus your operating profit is what lets you see how good of a job you're doing at making money versus how well you as an owner or owners are doing at running the business in general. The first section is to assess the team and their delivery. The second is looking at the owners after their owner pay, by the way. So if you have a high gross profit and well, you're able to operate your business efficiently, accordingly, yes, you're going to have a very healthy operating profit margin. That's what I would expect. And typically, it should not be less than somewhere between 20 to 30%. Again, the smaller your team, the higher this ratio, this percentage should be. And obviously, if you don't have office space or not, that's going to have a tremendous impact. So if you run things remotely, yes, your operating profit is going to be much higher. The third section is your operating profit minus your taxes. Very simple, very straightforward. This is what gives you what we call your profit margin. Don't confuse it with the first section, okay? That's your gross profit. Again, this is your profit margin, different. This is your bottom line after you have paid yourself as an owner, that's operationally and after taxes. This is what you actually get to take home without having nightmares with the IRS come April 15th, okay? We refer to this number as what you're left with for owning the business, okay? Very careful right there. This is a totally different number from what you get as owner salary because your salary is paid for what you do in the business, okay? Lesson in there. They're different. One's paid for what you own, the other one is paid for what you do. And well, your profit margin obviously depends on what your operating profit ends up looking like. But regardless of what it looks like, regardless of your circumstances, your profit margin should at no time ever be less than 15%. Okay. If it's less than that, maybe 10%, gosh, you're definitely in survival mode. And I'm confident to say that you probably are experiencing cash flow issues. Now, the reason I think it is best to go about it by putting floors in place like I just did in this video for you, it's because I have found that it is often easier to know where you should not go or not be rather than try and give yourself the perfect ceiling because it could cap you down the line in the future. And like Charlie Munger says, and I quote, "Tell me where I'm going to die, so I'll never go there." Very interesting. And well, if you are above these floors indeed, well, you now know if you have a healthy agency and by how much. And this is where things get rather interesting, okay? Because you have now taken the first of many steps to being able to spot very, very specific things inside your agency that make the difference, that allows you to steer it towards a smart direction, towards using your numbers to run a smarter business, which is exactly what we help creative agencies do. So if you're ready for accounting structure and operational clarity, you can book a free discovery call today with me if you're looking to work with us. The link is in the description below. And that's all I got for you today. Hopefully you liked the video. Hopefully you found it insightful. If you did, make sure you smash the like button for me, subscribe, follow the channel. And with that said, I'll see you in the next one.